Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Amy Zhang. She's Executive Vice President and Portfolio Manager at Alger. We're going to discuss why in challenging markets, small caps might be where you see some value. Amy, it's great to see you again. Welcome back to Trade Talks.
Thank you, Jill.
Where in the stock market are you seeing the most transformative trends right now?
Well, without a doubt, the artificial intelligence revolution is really the center of the market, I think. There's a lot of buzz, but opportunities are huge. And AI is really a disruptive technology, and that's changing the world. I think we're still in the very early stages of that transformation.
Well, investors know a lot about the household names, right? The large cap tech names. But can you tell us about small to mid cap companies that are also benefiting from AI?
Yeah, absolutely. Because I think the AI beneficiaries are really broad-based, and from that, there are a lot of investment opportunities in the small and mid-cap space. Particularly, people are just, as you said, household names are mega cap. Tech names. Here, we have a lot of companies outside of the technology sector. For example, in the consumer sector, one of the companies that we invest in is a small beauty company. They, sell beauty, health, and wellness products direct to consumer, DTC, online. And what they do is they use AI and machine learning technology to mine the proprietary customer data set. So as a result, they can have very accurate customer recommendations, and with very high, extremely high, over 90% of customer satisfaction score and a repeat purchase. So can you imagine a small beauty company, otherwise could be cyclical, but because of they use AI, they're really a user of AI that makes their growth much more sustainable and durable.
What about drug discovery companies? How are they leveraging AI? Give us an example.
Yeah, I'm glad you asked, because I think there's tremendous opportunity in drug discovery. And actually, one of our portfolio holdings, they use physics-based software and AI machine learning platform to identify and optimize, novel drug candidates, and as a result, they have much higher probability of success, and also tremendously cut down the development costs and time to market. Without the AI and machine learning, imagine doing 10 billion molecules. It's close to impossible, and with very suboptimal results.
Yeah, I mean, it'd be great if you could bring down costs with drug discovery. I mean, you know how expensive it is when it comes to R&D and getting these things to market. What about in the industrial space?
Yeah, we actually have several industrial holdings, but one of them is a leader in thermal and power management for data centers. As you know, data center is such a critical part of the AI infrastructure. So with the increasing need for computing density, you really require there's very high requirement for cooling and power management for high performance. So because they use AI and machine learning, and what they do for those AI-focused data center, we think they will see very sustainable growth in the years to come.
Before we get into the macro part, what other themes outside of AI are you working with within the portfolios?
Well, we have many themes because we always say we wanted to invest in motorboats with secular trends, because versus sailboats. Sailboats are a company that, the speed depends on economic wind. So you don't have if it's the wind languages, then you stop or you stall. And motorboats are the company that have idiosyncratic drivers that usually, is driven by innovation, that no matter in what kind of economic environment, they have idiosyncratic drivers can create value. So as a result, we're still very positive in healthcare, even though it's been underperforming, one of the worst performing sectors. But that's exactly where we see value in times like this. We think there's a lot of opportunity to find the gems in the rubble, so to speak, and of course technology, but consumer, industrial. But I think healthcare is one area that sentiment is very poor. But precisely for that reason, we think in terms of intrinsic value, there's a lot of opportunities there.
Let's talk about the macro. Are small cap growth companies still depressed? Is now a good time for small caps?
Yes, it's very depressed because, as you know, the S&P 600 growth, the small cap index is trading at about 17% discount now to S&P 500, and for the last 20 years, they've been, on average, it's been 15% premium. So reversion to mean what happened? There's a catch up, but of course there's a lot of macro noise. But I think once we passed the macro noise, and we are hopefully, I think we are towards the end of rate hikes because we've had 525 basis points starting last year. It's the most furious and fastest rate hikes in terms of magnitude and pace. And of course, small cap growth, no matter how wonderful they are, is still considered long duration assets. So I think it's really about people throwing baby out of the bathwater. But for us, we are trying to separate the wheat from chaff. That really, I think this is a fertile area for active management because in times like this. So actually we're very excited about the value that we see in small cap growth now.
Well, the higher interest rates, cost of capital, small cap companies are really sensitive to that.
Yes, I'm glad you said that, but the kind of company we invest in, because they structurally have high margin, because they're science-driven, capital-light, innovation-driven, actually, our portfolio have much lower debt-to-capital ratio compared to the index. So to that extent, I think we're actually very well positioned in a higher rate environment.
All right, Amy, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.